Hello and good morning, everyone. This is Almus Market Mornings, your host of Global Financial Update with me, Shikhar Garg. Now, folks, we see central banks are being quite vocal from the slew of commentaries received over the past few days that the tightening policies are here to stay. Interest rates are going to go higher despite all the crashing in asset prices. But at the same time, there's a fraction of markets starting to have concerns whether the central banks across the world are going too fast or too far. Now, interestingly, there was also a small update that saw reactions in the currency prices, at least for the domestic currency, USD-INR, that there was some delay in the incursion of Indian bonds in the JP Morgan index. Now, for the past few weeks, we have been having updates on the incursion by the end of this month, but this is now being postponed to next year. So there was some slight reaction for the market participants on these fronts. But JK, what are your thoughts? Like, what should we be seeing and what's happening around the markets?
Hey, good morning. So after the UK pounding on the markets on Monday, it was the turn of pain from Yuan weakness today, as it sliced through the multi-year resistance at 7.20. This is even as the PBOC continues to fix their central rate at a much stronger level than the market levels. There were even indications that they were advising bankers against selling forward and took measures to putting more margin, etc. But it has been no avail to stop the yuan from weakening. I think it's the deadly combination of economic weakness as well as outflows from the financial markets in China that's been, causing all this. And now that we have broken 720, which is a multi-year high, it needs a very big change in the fundamentals to bring it back, or if there is any massive intervention from Bank of China through some policy measure. That's actually been telling upon all other currencies today, particularly the Asian peers as well as the commodity currencies. Australian dollar has weakened more after a better than expected retail sales number that came today. So it's just a contagion effect of one currency or the other into the others. So euro is now going closer to 0.95 GBP after brief consolidation of 1.5 sessions yesterday and day before. It is back to slowly weakening mode. In fact, the Bank of England officials have not helped to stabilize the market, as they say that there is, while the fiscal announcement that have seen are justifying a strong action on monetary policy, they are not ready to act on that immediately. So market is now speculating that whether they will actually have a big rate rise or whether they are expecting the government to backtrack on some of the fiscal measures that they have introduced. So it's a highly uncertain environment. And in the meantime, we have seen the UK 10-year yields, rise as high as 4.54%. Just to give you a perspective, this month low was 2.82%, and that is a massive move for UK gilts. And now one more interesting thing, rather not a very comfortable thing, is that the terminal rate in UK is now pointed to around 6.20 compared to 4.5% in the US. No, but the investor confidence in UK is so low that even at such high levels of yield and projected terminal yield, they are not ready to invest into the UK gilts, while they are ready to buy probably on the US bonds more readily. But even the US bonds are still not buying seeing any sustained buyers, because 10-year yield is now almost at 4%, and 2-year continues to make highs. New highs rather. But yesterday's big drag up on the 10-year actually resulted in some sort of steepening in the 2-year 10-year difference, which is now at -34 from -46. For the euro, IFO data from Germany was of no help, and the IFO Institute is actually pointing to a recession going ahead for German economy. And there is an additional challenge, or rather negative development of gas leakage in the Nord Stream pipeline 1, which people are not ruling out as a cause of, because of any sabotage, but that is something not officially confirmed, but definitely it's causing further, effect effect on the supply of natural gas to Europe, and who is already facing several problems. So all in all, the currency space is getting a lot more attention because of the way dollar has been moving. And there are suggestions from some quarters that US should stop the dollar from rising too far from here. In fact, rising further from here. But it appears that Fed will not back off from current policy stance because of the dollar, and the dollar's rise will actually reinforce Fed's anti-inflationary course, and the widening current account deficit can be easily financed if their rates remain high. So, given U.S. authorities will be concerned, of course, by a bigger or the larger global market turmoil. So, it could become a constraint on their restrictive monetary policy stance if there is, a big fallout on their economy due to the other global economies issues. In fact, one of the officials from US has said that the Biden administration is closely watching some of the global economies which are on tenterhooks. So we will have more officials from US, rather Fed officials speaking going forward today, and the market will be very closely following their speeches for clues on how the markets are going to behave forward, and the policy will evolve, and particularly on the dollar. Stock markets took a pause from big fall yesterday, but definitely did close weaker, excepting Nasdaq, which had some relief yesterday. But importantly, S&P 500 is at a very crucial level of 3,589, and that is a 200-week moving average, below which it traded once in 2020 post-pandemic, and then in 2011 for some weeks. But generally, it is held above that. And given the current circumstances and the risk sentiment on the market, if it breaks through that now, I think we will have a much more domino effect of selling of stocks. And ironically, that is what the Fed wants, because if stocks fall, they create a reverse wealth effect and affect consumption, and then also affect demand push of inflation. So it's a new world that we're dealing with. It's a whole host of negatives on the geopolitics, economics, and monetary policies, as well as fiscal policy. So, and on the rupee, of course, as you said, we did have slightly stronger start yesterday, possibly due to half-year-end closing nearing. But then the news about postponement of inclusion of Indian bonds in the JP Morgan index changed that. And today morning, we have the impact of China momentum. We are already more than 0.5% weaker in the offshore market from the from yesterday's levels, and that should be a cause of concern for the local authorities, as well as we have to face more inflationary pressures from the imported prices. So rupee also will face some headwinds going forward, as more currency weakness is seen outside of India. And 82 definitely is very close by. We just have to watch what the authorities do at these levels, and also whether there is some relief due to half-year-end related selling in the USDINR. That's all from me for the time being. Thank you.
Okay, JK, that was quite wonderful. And folks, as JK mentioned, yes, there are going to be headwinds when it comes to currency markets across the globe. We'll see currencies being hammered or pounded, some moderation here and there, but the volatilities are going to stay. On the domestic front, as JK mentioned, Yuan weakness has traditionally been leading the back, whereas USD-INR has traditionally followed the USD-CNY, as there's also a bigger deficit, and it has also been one of the key metrics for our central bank to see what sort of valuation does our currency stay on. On the other hand, we have also seen UK yields having a massive move on the higher side, almost doubling in the past few days, whereas on the energy crisis front, again, it may not be direct or intentional, but there are updates of gas leakages in the Nord Stream 1, which can also put pressure on the euro again. So there's a lot of things continuously going on, and a lot of influential market participants are acting on their front. So, folks, there's going to be a good round of volatility in the international markets. I hope guys keep managing the risk. Till then, we'll come up again tomorrow with another round of fresh updates, and we say goodbye for the day. Thank you so much for listening.